Well, hello, everyone. We're excited to be with you today. Philip Corson here with Mike Flanders. I am just thankful that you've been able to join us and hope you appreciate and enjoy the information we want to share with you today. So, Philip, let's take it away.
All right. Well, before we get into the charts, let's start at the beginning.
So, this is the question we've been hearing most lately.
People just want to know, should I be doing something right now?
And it's a fair question.
Yeah, there's a lot in the news, and it can make things feel very uncertain.
So, what we want to do is walk through what's actually happening
So you can make good decisions.
and be able to do it without reacting to the headlines. So here's what clients are seeing right now.
You turn on the news, it's the same themes: wars, oil prices, inflation, tariffs.
Oh my, reminds me of the Wizard of Oz. And they're all happening at the same time.
Yeah, if you look at the slide, you see it just all piles into one place.
And that's what creates that feeling that everything is getting worse.
And when it feels that way, it's natural to think you should be doing something about it.
Right. But before reacting, it helps to break these apart and look at them one at a time.
So let's start with the market itself.
What we're seeing right now is what we call a pullback.
Yeah. And if you look at the chart, you'll see this happens every year, usually 4 or 5 times.
Right. And at some point during the year, one of those 4 or 5 times results in about a 15% market drop.
But the thing to remember is that most years still end positive.
So, bottom line is, this is not unusual.
Right. It's just uncomfortable,
Right. And a lot of the concern right now is coming from global events.
which makes sense. I mean, these are serious situations.
But if you look at the chart, markets have gone through many of these before.
And markets tend to react in the short term, sometimes sharply.
But over time, in the long run, they adjust and they move forward, as you can see in the chart.
Which is why these events usually don't change the long term outcomes. One of the main ways these events affect markets is through oil.
Yeah. And if you look at this chart, you can see how sharply oil prices have moved recently.
And when oil rises like this, it can push inflation even higher.
And that's because energy costs, they flow into almost everything else.
Yeah, that's right. And that creates pressure on both stocks and bonds.
But we've seen all this before. These spikes tend to be temporary as supply and demand adjust. So that brings us to inflation.
Yeah, if you look at this chart, you'll see that inflation has come down from where it was a couple years ago.
Yep, but it's still above the Fed's target of about 2%.
And things like energy prices certainly move it around.
Yeah, and that makes it hard to know exactly where it goes from here.
Yeah, I think the key point is we don't need an accurate prediction about inflation in the future.
That's exactly right. All we need is a portfolio designed to handle different outcomes.
Now let's look at the job market.
So if you look at this chart, things still appear pretty solid.
Yeah, but not everyone is experiencing the economy in the same way.
That's right. Some households, they're doing just fine. And
And others are starting to feel the pressure a little bit.
this is the kind of thing that gets a lot of attention in the news, of course.
Yeah, and that's what makes it feel like something bigger is going wrong.
Yeah, sorry about that. I accidentally clicked a little quick there. Even though the overall picture is more balanced than it sounds, they can feel like something's wrong. So another big topic right now is technology, especially AI.
Yeah, it's getting a lot of attention in the market.
But we've seen this pattern before, and it happens a lot with new technologies.
There's usually this early phase where a lot of money flows into it.
But it's real hard to know which companies will be the winners in the long term.
And that's where people get into trouble, right?
Yep. The winners in the headlines today aren't always the winners in the long run.
Which is why trying to pick the winners is so difficult.
Yep. And again, that's why we stay broadly diversified instead of betting on a single asset class, single stock, or sector.
Hmm. Another piece of this story is tariffs,
Yep. And if you look at this slide, the rules have changed, maybe, but the policy hasn't gone away.
yeah, tariffs can affect prices, businesses, and the economy,
But just like we always say, companies tend to adjust over time. They don't just sit still and take it.
which makes it very hard to predict how it all plays out.
Right. And like a lot of these headlines, it can sound bigger than it ends up really being.
Which is why reacting or overreacting to it usually doesn't help.
So now let's look at the bond side of things.
Yeah, if you look at this chart, um, yields are much higher than they were just a few years ago.
And that means that bonds are providing some real income again.
But their main role in our portfolios isn't to drive returns, though.
That's right. The purpose is to help offset the ups and downs or the volatility of equities stocks.
Mm. Especially during periods like this.
So we focus on a diversified mix of high quality bonds.
Then we just let them do their job in the portfolio.
That's right.
Well, let's take a look at what's behind market returns now.
Yeah, again, if you look at this chart, earnings are still growing.
But stock prices are already high.
Yep, that means going forward, returns are going to depend more on earnings growth continuing.
Yeah, not just investor sentiment or people's predictions of what they think is going to turn out well this year.
That's right. So the focus shifts to how companies will actually perform or their growth.
And since these large US companies often move together,
Yep, we don't want to rely on just this one part of the market.
that's why we say stay globally diversified across many different asset classes.
Exactly. So this brings us to the most important point of this whole thing.
Yeah, if you look at this chart, the best days often come right after the worst ones.
And that's what makes it so hard to stay invested.
And it's also what makes timing the market so difficult.
Exactly. Because if you have to get out, or you do have to get out at the right time.
And you also have to get back in at the right time.
Yep, you do. And most people miss one or both of those.
Yeah. So instead of trying to guess right twice and time the market,
Yeah, we just do the same thing we've been saying all along. We stay invested, we stay diversified, and we rebalance over time.
so where does all of this leave us?
Well, if you take a step back, not really much has changed.
Yeah. Markets always give us reasons to feel uneasy.
Yeah, there's never certainty. Reacting to headlines, though, is rarely the answer.
Yeah. The better approach is stay invested, stay diversified, stick with the plan.
And if you're feeling uneasy or thinking about making changes,
Talk to us first.
yeah, we are very happy to walk through it with you. And we wish you the best and hope that you enjoy your investing and sticking with your plan. So long for now, folks.
Take care, everybody.